The Hirschler Swordsman here. It's January the 9th, 2025. I'm gonna mostly talk about investing theory in this video. I mean, that's what I really enjoy, the theory crafting. And of course, I would argue that, I mean, the theory comes first, and it's up to, we see years later what the results were. I mean, if we did above average decisions, etc. I mean, that's all. I mean, everything comes down to theory. It's like in practice, we'll know that much later on if we have on average made good decisions, because we don't know exactly what news is going to come out. Even if we expect good real results, we don't know exactly how good the results are going to be, and they can be bad as well. Then you don't know how the market is going to react to it, so you can't tell you. I mean, even if you think something, you think, oh, this hole is going to show 5 meters of 10 grams per ton. It was some assay, and you're like, that's going to be great, because that means whatever you add on. Let's say it's a, I don't know, new discovery, whatever. It's like, oh, that adds on, that hole alone adds on 5% of value or something like that. Then it wouldn't be really a discovery hole, I guess, because that's probably going to add on much more than 5%. Anyway, so in your mind, it's like that would be great, and exactly that kind of as a result comes out, and the market sells it off by 5%. You might be right, let's say, that it's actually increasing the value by 5%, even if the company was fairly valued. But the Mr. Market doesn't agree with you. And in reality, we don't know exactly what the assay results are going to be, or most news is going to be. So we're really making guesstimates on news, and then we don't know what the reaction to said news is going to be. We don't know what the sentiment is going to be 3 months from now, or even tomorrow, or what the geopolitical environment is going to be, or the macro environment is going to be, and everything that might play a part in how the market accepts that news. So it's really Schrodinger's cat within Schrodinger's cat within Schrodinger's cat, and there's a thousand different Schrodinger's cat affecting one Schrodinger's cat, yada yada. The only thing we know at all times is what price Mr. Market is offering to sell or buy partial ownership of a company. That's why price is, of course, so important. I mean, if price gets cheap enough, a lot of the news you don't really at face value take any risk on. I mean, if you buy something cheap enough, and it's like, oh, it's not pricing in a discovery at whatever target. So even if it doesn't end up making a discovery, I mean, you don't really take a hit if you bought what you already have for cheaper than it's worth. So that's just free upside. So then you don't really, I'm not going to say care, obviously you care, but the implications are very different than if you bought something, a pre-discovery play, drilling one target, everything is about the target, they miss. I mean, that kills the story basically. So if they have nothing, and even if you paid 5 million for it, in a sense that's still too highly valued. But if you bought something for, I don't know, 100 million, it's worth 300 million, and they have a lot of exploration potential on top of that. I mean, you're not really taking any risk. But if they make a discovery, you'll get the benefit. So it's in a sense, it's a no risk, high reward potential, at least from that target, that exact venture. But anyway, thanks to the sponsors, markets haven't done much. I mean, crypto is, well, languishing, I was going to say. Metals are actually doing quite well. Markets, US markets seem to be, I mean, going nowhere really. I want to start off by one thing I found pretty funny. It's like somebody summarized one of Howard Marks, I think, recent memos. And this was one point. It's like, what is a bubble? For Marx, a bubble is just about high prices. It's a state of mind. Key signs: no price too high thinking. Never too late to buy, because it's always going to go higher, basically. FOMO driving investments. Blind faith in this time is different. Do you know anything that might fit this description of a bubble? Yeah, I think so. Uh, Looking at Bitcoin here, looks a bit precarious. I'm not a technical analyst. I don't know exactly. I mean, there's probably some exact requirements for what qualifies as a head and shoulders top formation. But this looks pretty toppy. Uh, and yeah, I mean, I think Bitcoin, especially Bitcoin, fits this criteria because you can look at Dogecoin or Fartcoin. I don't think actually it fits the criteria. It's like, I mean, it is a bubble by definition since it's worthless. That's the funny thing. But I don't see. I mean, it's kind of a accepted trading sardine in a sense. Uh, I think so at least. Like that's at least providing the how to say it, like the utility that I think most people are on board with. It's like it is a casino. Dogecoin, people are betting if it's going to go up or down, if the next move is going to be up or down. Pure speculation, but I don't think people think it's that no price is too high or anything like that. It's like literally trading sardines. It's like everybody knows it doesn't have value, but it's a good, but it's a perfect vehicle if you just want to gamble in a sense. For Bitcoin, I actually think these bubble characteristics are in play. No price is too high. I mean, you see that all the time. I mean, you see people talk about that everything is going to be swallowed up by Bitcoin. I mean, I see some people with 500,000 or millions of followers talking about every asset is going to be reflected in Bitcoin, and there's 200 trillion dollars worth of stuff out there, in USD terms, and that's all going to be reflected in Bitcoin. I mean, stuff like that basically translates to no price is too high because it's always going to go higher. If Bitcoin is at 100,000, everybody says, oh, buy now because it's going to go to a million or 10 million. At 1 million, everybody's going to say it's going to go to 10 million or 100 million. And at 10 million, you know what I mean. I mean, that's what we've seen all the time. Just keeps increasing the target price all the time, despite the fact there's like, okay, some call it like digital gold, and it's different this time because, of course, for the first time ever, gold is not going to be the tier zero asset anymore because Bitcoin does what gold does and better. So, for the first time in 5,000 years in human history, first time in civilization, uh, uh, gold is going to be supplanted by this artificial token that requires the energy consumption of Poland to even work. I mean, I'm I'm betting against that in the sense that I don't own any, of course, and FOMO driving investments. I mean that's kind of a self-explanatory. I mean that's basically all you see. I mean if you look at the Bitcoin accounts, uh, and there's a lot of them. I was like every other person on Twitter seems to have Bitcoin or crypto in their bio, etc. Nobody's really talking about I mean, what the actual value is or anything like that. It's just that it's all, whatever happens, and I've seen other people make fun of this fact that I made fun of quite recently, where it's like people are literally saying that anything bad that happens to Bitcoin is always good. And I saw someone do a tweet about some potential hurdle, let's say, and he ended with like, but of course everybody's gonna the Bitcoin maxes or whatever you would like to call them, they're gonna say this is actually positive, and of course people came into the thread and said, yeah, this is positive because X, Y, or Z. So it's that kind of that's really a religion in a sense. I mean, there's things obviously that could be bad for the price of gold, especially paper price of gold. Uh, but over time, as we've seen, I mean, that's the closest thing you can come to store of value. Well, it is the only thing almost that has been a store of value in a sense from in terms of a financial asset. It's just that yes, sometimes people have gotten gold stolen. Sometimes it's been confiscated. but the gold that's been around has still, on a global perspective, always retained its value. And that's also one thing that the Bitcoiners, Bitcoin maxis, basically seem to disregard. I mean, they call it digital gold, but at the same time, unlike gold, which really over the very long term only keeps up with inflation, meaning a purchasing steady purchasing power. Bitcoin is basically, I mean, if you read what people write and why they're all in and all that, it's basically because it's gonna go up forever. I mean, if you owned gold, if you bought gold 100 years ago, assuming you're a vampire, if you bought 100 ounces, that's around the value you will have today. I mean, you can buy about as much as you could then. So it's like, yes, in fiat prices it's going up, but you're not getting richer from owning gold for eternity. You just keep your purchasing power. But obviously, that's not why people are all in Bitcoin. And actually, I don't think that's why most people are buying gold either. I mean, I think it is a lot of speculation, let's say, especially with silver. It's like it's going to go to $500, etc. So yeah, I mean, I think it's kind of contradictory. That's like, oh, it's digital gold, but unlike gold, this is actually going to make you rich as well. It's going to create wealth forever. Gold doesn't create wealth forever. It stores wealth and has stored wealth forever. But it's not like your purchasing power is going up forever. It stays the same. So it's like you have a lot of this stuff going on. Anyway, I just found it funny because again, it's like I can. I mean, I would consider Bitcoin to fit all of these, criteria, basically. Yeah, but let's see. I mean, what happens? I don't own any, so in a sense, I don't have any horse in the race. And I mean, if you like to buy real assets cheap, like I do, I would say that crypto, etc., is probably the best thing that has happened to the junior sector. And of course, most will disagree with that. I bet 95% will disagree with that, and I can understand it because it feels like a curse a lot of the time, simply because the juniors are cheap. But again, it's like in order to make a lot of money as a value investor, you want to be able to buy stuff cheap. The cheaper, the better, because nothing stays cheap forever. So if we want to make a lot of money, we have to be able to buy cheap first before we can sell high. And I think crypto is a main culprit in keeping the interest so low in the real asset space. So when that flips, I mean, when the chickens come home to roost, if Bitcoin is in fact a bubble and not this perpetual wealth creating machine, I think we will be rewarded. And I think, like almost always, I mean, it kind of rhymes that the worse the bear, or the bigger the opportunity, the bigger the future reward. So whereas most people can't even fathom that the juniors will have a bull market anytime, let alone anytime soon, I think we might be in store for maybe a junior bull that's gonna be on par with the 2000 to 2011 run, or 2008 bottom to 2011 run, because it fits. I mean, the reversion to the mean, and the cheaper a sector is, the more bombed out it is. When it actually gets going, it typically, I mean, the bigger the crash, the bigger the rally, the bigger the rally, the bigger the bubble, the bigger the crash. Just look at Japan, which took like 40 years for the stock market to get back from extreme bubble valuations in 1980. So again, it's like the more I see and ponder the fact how sucky this sector is in a sense, I mean, that just makes me more bullish, because I mean, if there's anything you should have learned by listening to all the, let's say, historic value investors and people who understand the cyclical sector, that's basically what they all say, that the worse the bear, the bigger the bull, and all that. Yeah. Anyway, I thought I would go through a bunch of common sense things in a sense. Let's zoom in here. It is better to have high conviction in a good case than low conviction in a great case. Conviction is what enables us to buy low and use volatility. Low conviction is in an actually great case will still probably lead us to make wrong decisions in the face of volatility. I mean, it might sound counterintuitive, but it's like it just kind of struck me again when I was today looking around at different developers, advanced explorers, up and coming producers or producers. Like everything that's decent looks like a buy, or something is just so cheap. There's like, yeah, I mean, if they execute their plan over the next 2 years, if it's cheap now, it could be absurdly cheap then, or I mean, compared to today, yada yada. So it's like I just that's almost irritating and frustrating because like there's so much stuff out there that I would like to buy. It's like, oh, I mean, there's a long list, and I pretty much want to add in every holding I have, and there's tens of companies I would really like to buy as well. So I have like, I don't know, pretty much right now it's like no dry powder, but maybe like 40 different cases, companies I would like to own a bit of or own more of. So it's just overwhelming in a sense. That's the frustrating. It's like the curse of decisions. It's like, how do you figure out? Because I want to own the cheapest as well. So like, how do you actually figure out what the cheapest are? And then the question is, I mean, let's say you look at 20 different stores and you already have almost no dry powder and you're happy with the holdings you have. You think what you own is super cheap. It's like maybe within those 20 stores, there's 3 that are actually really, really cheap. I mean, not only cheap, but it's like exceptionally cheap, or the risk reward is much better than the other 17. It takes a long time to figure that out, of course. And my point with this was gonna be that I mean, it's kind of okay that let's face it. It's like we don't need to have the absolute best cases. I mean, if we have 20 stores, if we have, 2 really high conviction, or 4 or 5 really high conviction stories, where it's like we have, a few percent or more in each of those stores. I mean, we should do great, especially if let's say, yeah, again, 20 stories, and it's like 16 of them are like cheap, relatively high conviction cases at least, and some are like very high conviction cases. It's not guaranteed that your high conviction cases are the actually best cases around. But if you have high conviction, even in good cases, that at least will allow you to, when price declines, if you're convinced that this should be a 200% return over the next 2 years or 300%, if it goes down and you're like, oh, well, then I'm going to get 220% to 300 and whatever percent, you're going to be more inclined to buy more of that and at least not sell it. But if you have a position in maybe the greatest risk reward there is, but you have low conviction, doesn't matter if it's actually if you've had endless amount of time and go through every single junior, had perfect information, even if that was the absolute best risk reward in the entire space, if you have low conviction, you're not going to know that, of course, and you might end up selling it low as it retraces. Maybe the expected return in that one is 300 to 400% instead of 200 to 300%. So you can end up making mistakes even if the store is better. So it's like, I think my point is to highlight just how important conviction is. So then you have to understand what you bought it. If somebody says, I like this story, I buy the store because somebody else likes it. I have no idea what he really sees or how it all fits together or what the risk reward is. Yada yada. I might have conviction for a time because that person's like, he's very hot on it, and I respect his estimation of risk reward. Let's say he goes on a vacation or volatility hits or whatever. He's not active. I might be able to buy the first 5% decline or the first 10% decline. Let's say it goes down 20%. No news. Or maybe there is some news out, but I don't even know how to value it, and the market says, oh, it goes down on that news, like we see with a bunch of drill results. But maybe the drill results were actually not bad, or at least the company might be so cheap already that even with this, let's say, underwhelming news release, even if it is underwhelming, it's still the cheapest story around. And you should buy even more because the market's unfairly punishing something that didn't really make the case worse. Well, even if it made it worse, it's still the best one, so it shouldn't really go down because it's still the cheapest one there is. It should go up, actually. If you can do that because you don't have any conviction, I mean, then it doesn't matter how good the case is, because you might end up, when you should be just auto buying more, maybe exponentially so, you end up selling. Let's say intact case, best risk reward there is, best case there is, you don't have conviction, you end up getting shaken out. Compare that to having a good case where you have conviction and you at least don't sell low. There's a big difference there. Well, this one also is like, you don't need a high hit rate, you need good risk reward across the portfolio and let the reward side play out to pay off the numerous risk sides. I mean, I looked through one of the diversified HODL folios. I don't remember exactly how many different companies over the last 3 years that portfolio has held, at right now or at some point in time. Because sometimes I just, take a really small position, change my mind later on, whatever. It's like almost a watch list kind of thing. Or I simply find, I mean, sometimes like recently with, let's say, First Nordic, it's like, okay, I had a bunch of cheap stuff, but like, oh, this was so cheap, or is so cheap, that I decide to sell out, maybe, reduce positions and maybe sell a few positions, probably small to begin with, but I sell them, not because they're sells. I might think they are the top 5% of risk rewards in the sector, but if I find something that I think is the top 1%, you can warrant selling something that is a screaming buy to buy something that's just a more screaming buy. So my point is that there is certainly some turnover, etc., etc. Anyway, the point is that I think less than a third of all the different companies held by that portfolio over the last 3 years, less than a third actually showed positive returns. So basically one can see it as a sub 30% hit rate. Still, that portfolio is up over the last 3 years. Why? Because the typically the high conviction cases where I had a higher weighting to begin with, they on average performed. They beat the median junior, let's say. In fact, I think that the top earner, I don't know, it was either Magna or Snowline, returned more than the top 8 losers combined. And I think the top 3 actually returned more than all the losers combined. And 2/3 of all the positions ended up with a loss or showing a loss. So think about that. I mean, I say this all the time. I mean, it's like it's all about risk reward. You don't even need a good hit rate. But the funny thing, I don't know if I tweeted that, but it's like, when you think about it, since it's asymmetrical, the high risk, high reward, meaning that a stock can go up theoretically infinitely, but it can only go down 100%. So one good story can pay for a shit ton of losers. So you don't even need a high hit rate to make money, to be let's say a winning investor. But at the same time, the funny thing is, like, most people, of course, don't make any money ever. Never gonna, never gonna have a good strategy. Always gonna end up losing money even over the long term. I mean, to lose money in a bear market, that's no achievement at all. if the median junior or the mean junior is down 70%, if you're down minus 50%, you're actually outperforming the industry. But it's not going to look like a win. So my point is that it's easy to lose money on paper in a bear market, and it's super easy to make money in a bull market. But over the long term, if we make crap decisions, we're going to end up losing. And you don't even need a high hit rate. So those you might need above average appetite for risk, though. That's one thing actually. That might be an edge at times that you dare to have. I mean, that's why I don't do never have a position above 1% or something, or 5%. It's like, no, I let the opportunity dictate it up to a certain point. And typically the margin of safety, the lower the risk to the downside, the higher my position size that I'm okay with is going to be. But still, Condor has been the biggest loser, I think, over the 3 years, because that was one should say it's a high risk, high reward story, because it was literally a pre-discovery play. I just thought it was a much higher chance of success than the average maiden drill campaign. Because, all the context, and I've talked about this before. But that ended up being a loss. So far at least, it went down a lot, and as I've said, I sold a lot of that because the case changed, and now the case is changing again with the new projects and Cobra Orco and yada yada yada. But okay, big loss, a lot of it monetized. So a paper loss turned into a permanent loss, because let's face it, if I didn't sell anything, within 2 years they might have made a discovery and the stock is at 300 million. And if I didn't sell and didn't convert that paper loss to a real loss, there is a possibility that that's going to convert back to a paper profit, and if I sell then at a profit, it's actually a monetized profit. But that's again theoretical. That's also the thing. It's like you never know what's going to happen. That's the thing. Anyway, yeah. So going back to this, for example, a 1% position that gets cut in half, that's only minus 0.5% to your portfolio. 1% position that goes up 300%, that's 3% increase, so that's 6 times. Again, this one win in that case paid for 6 similar sized positions that got cut in half. Still, you see people all the time, it's like, as soon as somebody owns a stock that's down, especially if people dislike someone or whatever. Most people actually do enjoy seeing other people fail. That's just a human condition, because they think intrinsically it makes them feel better off if they see other people having a tougher time than them, for example. That's kind of why I think these garbage magazines that talks about celebrities and what celebrities, an alcoholic who has lost money, I think that sells a lot, because people in a sense feel better off, even though nothing changes. If James Franco is a alcoholic that goes bust, changes nothing for me, but at least I can say that that guy had let's say a lot of money and a lot of fame, and now he's worse off than me, so it's like, great, I'm not that bad off. You know what I mean. My point is that if you make I still get I think it was yesterday, somebody just commented like, well, you said SK was going to go to $8, and then I asked, like, did I guarantee that SK was going to go to $8? It's like, I don't think you responded to that, but I have a hard time seeing. I have a hard time seeing that I guaranteed anything to happen. The likes of SK for sure going to $8. If you read me, I basically say nothing about guaranteed wins or guaranteed losses. It's risk reward all the time. Even my highest conviction picks right now, I don't pretend that they're guaranteed wins. I can say that I think they're guaranteed cheap, meaning they're risk reward. They are priced cheaper than they should. Then the risks are to the upside in that case. But I don't know exactly what's going to happen. I don't know exactly how the world is going to be tomorrow. There might be a nuke somewhere tomorrow. I have no idea. But people jump on each other's throat. People are quick to point. I mean, I see people, bash Eric Sprott when he has losers, or like McEwen, or any of the kind of famous investors. I mean, that goes for Warren Buffett as well. It's like, he's losing on something. There's going to be somebody pointing out as like why he was dumb to do that, etc. Like inferring then, well, oh, then I'm better than that guy. But in reality, I mean, I've seen people say, because some stock I own is down, they're like, oh, I bet he's bankrupt by now. Uh, Implying that's like, yes, I for sure went all in on every single, high risk, high reward case. Whereas in reality, you don't even need a high hit rate to make money. But still, this is the sector. This is not a sector if you can't afford to look stupid, and a lot of the time, and for long periods of time. If your ego is fragile and you can't stick with a, whatever, being called a bag holder, etc. And I mean, if you can't cope with it yourself, I mean, you don't need to tell other people. But if you can't even look at your portfolio and see that, oh, I mean, I lost money on a lot of stuff, so that automatically means I'm so bad that I have to quit, then the sector is really not for you, because anything without a change in value can go up or down 30%. And it's like, usually when I start buying something cheap, it tends to get cheaper, because this sector tends to exaggerate the uptrends and the downtrends. So if something starts to be cheap at X, it might get cut in half again before the actual bottom is in. So you're going to look stupid going into that bottom. If you can't cope with that, you're not going to be increasing your position, assuming your conviction in the case is the same, and as price goes down, you should actually buy more. If you can't do that, I mean, I don't know. It's like the one thing I'm good at is buying cheap and buying low. And I'm not perfect at it, but I am good at buying downtrends. I'm good at buying falling knives or whatever if I'm convinced that the value is higher. I'm very bad at selling. Always been very bad at selling, and that's why I think being, pretty much all in and having to do value shuffle, it kind of forces me to, in a sense, buy cheap and not really sell high. I mean, I don't really necessarily expect to own anything that's actually trading at a bubble valuation. If it's overvalued, I expect to be pretty much long gone already. I mean, now it's hard to find anything that's like really overvalued. So now it's more that you sell something that is the least cheap of your holdings to buy something that suddenly maybe became even cheaper. But again, it's like a high conviction 5% position that goes up 300%, that's plus 15. So that pays for 30 of these 1% positions that got cut in half. Yeah, so I mean, maybe one could say it's been the 80-20 rule. It's like 80% of the returns have come from 20% of the holdings. I would guess that's, I mean, along the lines what has actually happened in that portfolio over the last 3 years. But yeah, my point is, again, it's like we are in a high risk, high reward situation. You have to let the high risk, high reward pay off for the high risk. And yeah, this goes into that. The risk side can happen in a day. I mean, any company can put out one news release and that's minus 50%. But if a case has 300% reward side, that might take 12 to 24 months. Good luck in this sector with a short time frame like everyone else. Multi-baggers happens over time. A stock being cut in half can happen in a day. So imagine you have a time horizon of a day, or you're only a catalyst hunter. You're only betting on the next assay results, high risk, high reward assay results, and your plan is to only hold it for a day, sell after the news release. You're either going to get, let's assume it's a pre-discovery maiden drill campaign on one target. If it fails, it's going to be down 50%. If it's up, it might be up 100%. I mean, some go up even more, and some barely go up. Whatever. My point is that for the reward side of the asymmetrical risk reward to play out, you need time. If you held 20, maybe I actually talked about this higher up. I mean, we can look at this. Imagine you have 10 high risk reward stories with equal amounts, so meaning 10% in each, and they have 20% chance of success, high risk, high reward, and fail ones give you -60, successful ones give you +400% over 2 years. 8 will fail, 2 will work over 2 years, but you sell the 2 future winners after the first positive news release and 50% pop. Auto lose. Why? Because that doesn't add up. You can't have high risk and low reward. That's what this portfolio would be if you employed this very strategy. That you had bet on 10 different cases where the case was only short term, it was the very next news release. And since making a significant discovery is kind of hard, so we assume the chance of success is low. Maybe that's 20%, maybe that's 5%. I mean, nobody knows for sure, but let's assume it is like that. Those 2 winners that pop 50% on the very next day after a news release are not going to pay for the 8 ones that went down 60%. So if you employ this strategy, you're pissing away money, and the more you do it, the more. I mean, if you found 10 cases today, put 10% in each, all have maiden drill results tomorrow. This happens, 8 of them go down 60%, 2 of them go up 50%. You sell all of them, find 10 new cases that will have maiden assay results 2 days from now. So you're just lighting cash on fire, basically. This is never ever gonna work because the reward side doesn't compensate for the risk side. But again, if you gave it 2 years. So you bet on 10 companies and said, I'm gonna hold these for 2 years, not even gonna look at the portfolio, whatever. You imagine that, hey, the ones that make a discovery, if it is indeed a significant discovery, that's gonna be worth more in 2 years than the day of the actual just first discovery hole, because a discovery hole is still just a discovery hole. In 2 years, they might have actually a deposit that's worth, I mean, it could be way more than that, and that depends on, of course, what price you pay to begin with. I mean, if companies valued at 500 million, they drill a discovery hole. I mean, even if they find something worth 500 million in 2 years, that's not really a good bet. But if it was valued at 10 million or 20 million and they find something worth 500 million, then of course over 2 years could be also much higher than 400%. But my point is, your strategy has to have a reward function, and the way to capture the reward side of the function that in a common sense way rationally pays for the risk you're taking. That's the point. I hope that makes sense, and you can think about this yourselves. I mean, I think there's a lot, and I'm going to get to that later, I think. Yeah, so I mean, this is kind of on that same note. One of the most common mistakes is to have way too much risk for way too little upside. Let's say you bet on a grassroots maiden drill campaign for a quick buck to the tune of 50 to 100%, aka short-term catalyst hunting. That's rampant in this industry. That's rampant in every industry basically. There is nothing more attractive than a big return as soon as possible. That's basically what 95% of people are looking for. I also think that's why trading is so popular. Because it's almost about imminent returns, or the potential for imminent returns. Let's say the chance of significant success is 10%. If not significant success, it will go down 50%. That is the game you're playing. If your case is the next high risk, high reward news release. And that's, again, a lot of people fit this description. They're in something because they think the next news release is going to be good. And they think that because it's going to be good, if it comes out in line with expectation, it's going to pop. a lot of the time that's kind of priced in, or you have so many people that have bought it that it might not even be really priced in, but there's still so much pent up selling after the news release because so many people were planning on selling the news release regardless of what the news is and regardless of what the price is or the value is. So even if it's cheap, they're gonna sell because they just were in it for one news release. Anyway, with 10% chance of success, 90% of the time you will lose -50, and 10% of the time you will make 50 to 100. Again, this is a terrible case bet, and more often you make it, the quicker your PF will disappear. The risk reward proposition does not work with such low reward to offset the high risk. Common sense, you see it absolutely all the time. I actually started off doing stuff like this, betting on maiden discovery plays, and in my mind I was buying the potential for a 10-bagger. And that is theoretically okay in a sense. I think I took two big positions though. I didn't diversify enough. I think I mostly overestimated the chance of success. And also it's like if I am taking risk, I gotta make sure that I can stick it around for the 10-bagger return in that case. Whereas in reality I think it usually goes like this, that people who are in stuff that actually might work, or they take the risk of a discovery, but when the discovery happens they sell way too quickly. So again, even if it would become a 10-bagger to offset the huge risk and the many other failures of similar cases, you can't enforce it in practice with your own investing, and then it doesn't really matter, right? If you sell every 10-bagger after it becomes a 2-bagger, you're never gonna have a 10-bagger. Did this myself a few times early on. Rule of thumb: if you have a case that is short term, extreme example, the very next news release, then you probably have a terrible case, and that's of course what most people have, and that's if they stick to doing that, they will never make any money. They will continuously lose money. Even if they make money in a bull, they're gonna lose it all once the market changes, etc. If your case is today's price will probably look cheap 12 months from now, and after these expected 12 news releases, I mean, you have an idea what the news release is gonna be. You know a story well enough that you can see X amount of news releases over the next 12 months, and you think that, if I had to guess, I think if these 12 news releases happen, preferably the bar should be low, that even if 2 of those 12 happen net positive, you could make money like 10-20%, whatever. If all 12 happen, you might make 300%. Then you might have a great case. Assume there are no risk reward treasures to find in the short term. Again, it's like I find myself, when I look into, I spoke about this recently in another video, when I find something, it's like, oh, this company is expected to increase production by 2026 or 2027. It's like I get bored. It's like, Jesus, years? Are we talking years? And then again, when you, because that's my initial reaction. I mean, most people probably think that, well, I think the marginal investor is like, if it's 3 months out, it's already too boring. But when you think about it, it's like, well, assume that you think there's an 80% chance they're going to be able to do whatever positive development over, let's say, 2-3 years. And if that happens, this company is going to be worth 400% more than it is today, more than the price at least. That's obviously potentially a great case, especially if it's kind of cheap already based on their production profile today, for example. I mean, stuff can happen, so it's not like it's risk-free because mines can run into troubles. But the idea is that, I mean, let's say you buy something that's pretty cheap based on today. You think there's 80% chance they're going to be worth 400% more than the current price in 2 years, assuming they execute, and you think there's an 80% chance of that happening. If they don't execute, yes, there may be, let's throw in 10% that they actually go bankrupt, minus 100%, but also 10% that, I don't know, it stays put. The price is the value in 2 years is the same as price today, for example. So like 1%, 10% chance that you will actually have a minus 100, but an 80% chance that you will get plus 400%, for example. That's a pretty compelling risk reward. If you could find a bunch of those stories where it's like 1 in 10 is going to fail in that sense, 8 in 10 is going to go up on average 400%, I mean, you would have a turbo. I mean, the compounding results of that portfolio would be absolutely obscene. But in the moment when you hear that, it's like 2-3 years. Are you kidding me? That's too long. But when you actually think about it and are realistic with time frames and compounding, you're like, wow, I mean, this might be the best thing since sliced bread. So in the short term, there's not a lot of opportunity. Yeah, nobody gives a shit about news releases, even high probability positive ones that are 3+ months out. I mean, this is obviously just a rule of thumb. Everybody and their mother cares about an expected positive news release a few days from now. And again, I think that's what we're seeing with some of the, let's say more prominent exploration stories that come out with good news, but it's like kind of met with selling, exaggerated selling, I would say. I think that is just a sign that there's a lot of people that are wanting to get, quote, rich on the very next news release. And I went through this user, I think it was in the Goliath forums, like one news release, 5 holes, and he sells 50% of his portfolio, puts it into something that's been doing well, where he also obviously think, well, it's been doing well, so that means it's going to keep on doing well. I mean, that's the level of strategy a lot of people have, and that might work for a time, but is that a disciplined, sound strategy that's easily replicable? Is that a word? I mean, I hope you understand what I mean. I don't think so. Everybody and their mother cares about an expected positive news release a few days from now. The thing with future is that one day it will be present. Patience, arbitrage. Again, if there's if you see a positive news release, an exciting one, 4 months from now, today you might not be paying anything for that. Maybe not, maybe literally nothing. And you think there's an 80% chance that's actually going to happen. Then let's fast forward 3.5 months. With some news or whatever, the company said, yes, this is in fact going to happen or something like that. So it's like it's up to 95% chance of happening, a positive news release. At some point, it's just going to be days left for that positive news release. And at that point, people will indeed care, and people will probably buy in just in order to sell the day after the next news release. So then you get paid, in a sense, for the news release, because then people care. So if you can buy a bunch of news release, probable positive news releases or potentially positive news releases that are like 3+ months out, up to 12 to 18 months, and you're not paying a damn thing for it. Imagine if they played out and you paid nothing for them. Boom, boom, boom. You're gonna get revaluation on the first one that might be 4 months out, and then the next one 6 months out, yada yada. So you're just stair-stepping the value higher, and the people will again increasingly care about the next and the next and the next. But you cared about all of them today, way before anybody else cared. So if you sell going into the first positive expected news release in 4 months, you might get 20%. And hey, I mean, that's, if you get 20% in 4 months, that's absolutely insane compounding. If you hold it after that, and you keep it for 6 months where there's 2 positive news, you might be up 40%. And after that, there might be 2 more before 12 months are up or something. And let's say 4 or 5 good news releases have happened. I mean, there's cases where there could be a lot more than that, but let's just stick with 4 or 5. Let's say every single one of those news releases is worth, if you wait for them, 20% today. So it's like you're gonna have 80 to 100% returns in 12 months because you bought the news releases nobody priced in today. Perfect. I do think, again, it might sound arrogant, but it's like with common sense, some basic concept of risk reward, patience, the more the better. I think, I mean, I don't see how you lose over the long term in this sector or in the markets overall. It's like common sense. I mean, Fartcoin is a thing, Dogecoin is a thing, Bitcoin maximalists are a thing. Is that common sense? I don't think so. And there's trillions in crypto. Some basic concept of risk reward. I played poker and I didn't appreciate the poor risk reward in going heavy into pre-discovery plays because at that point I hadn't really figured out that I hadn't really realized that even if a junior makes a discovery and becomes a 10 bagger, that's not happening on day one of the maiden assay results. But all the risk, in a sense, happen on that day. And it takes some time for the market to price stuff in, especially in a poor sentiment environment. I mean, you've seen it in this sector over the last, let's say, especially 2 years. Good news gets sold off. Even if there was no real ramp up in price going into it. There was no hype. Still, it gets sold off, even if it's good, because it wasn't good enough, or it's a liquidity event. There's simply so many people who want to sell, especially, let's say, there's tax loss, silly season, and all that. So there's a bunch of different things that can happen, and when you figure out, it's like, okay, right. I mean, even if a company makes a discovery, goes up 100%, maybe they went from having a 5% chance of making a significant discovery with these results in hand, or the chance might be 20-25, which is many times higher than 5%, and they actually only went up 100%. All of a sudden, it's like the risk reward is actually better, so I should maybe not even be in it pre-discovery, but post-discovery 100% higher, then it actually makes sense to buy. The risk reward is actually much more favorable at that point in time. So if you have all of these, and these are very rare, this almost nobody has, this not even I as a ex-poker player really had it in a pragmatic way when I started off in this sector, and most have not even played poker to begin with. Common sense, very hard to stick to when 95% of everything we read is not really common sense, not from an investing standpoint. And to again stick with it, that's hard. So people might brush over this. It's like I cannot emphasize enough just how I think this is basically enough to beat any sector forever, or make money forever. The problem is, of course, to get the sense of risk reward, and that goes into common sense as well. You still have to in some way understand the value proposition of a sector. I mean, if you have no idea about gold mining or exploration or what a good drill result is and whatever, how can you appreciate the risk and reward? That's hard. So I mean, you still need a basic understanding. You still need a circle of competence, or you need it to be within your circle of competence. But then also, I mean, you can have a lot of crutches. Like, okay, company X, a $40 billion company, invests in junior Y with a 20 million market cap. I mean, you can obviously, just based on common sense, it's like, okay, what would make a 40 billion market company care? Well, that's if they see there's potential for $1 billion price. And you're looking at 20 million market cap. I mean, do you need to be a rocket scientist to figure out that, oh, there's probably some upside potential in this, like legit upside potential, because a multi-billion-dollar company that knows everything about mining and geology has actually done all the due diligence for you. They're saying there's billion-dollar potential. I mean, then you could just, of course, you don't know exactly the chance of success, neither does the big company, but you can say that it's, I mean, there is a snowball chance in hell that it is a high reward case with I mean, assuming also you should assume it's high risk. Still, if you picked up 1% of those and had 20 such stories with like third party validation, I mean, again, you don't really need to know the sector that well. It's like you whatever. If Microsoft invests in some, I mean, junior tech company. I mean, obviously, if Microsoft, they have what, $2 trillion in value. I mean, obviously, there's got to be some potential upside. They wouldn't be buying something at 50 million if they think, oh, this is probably worth 50 million, or has no chance of being worth more than 50 million. So yeah, common sense is underappreciated and probably underused. Um, yeah, I mean, this is what I was talking about earlier. You can be a long-term winner with a 25% hit rate or even less. In the public domain, you will be called a clown for every single loser. So again, and that's obviously mostly coming from losers themselves. I don't see none of the investors I consider to be really good. I mean, they're not really out there degrading people that, oh you owned stocks of this and now it's down, what a clown you are. They don't have time for that. They know how investing works. They know how a high risk high reward sector works. um, and they have a lot of bag holdings through the years as well. I mean, yeah, bags. So they don't really uh, I mean, they don't throw, what's the saying? They don't throw rocks in a glass house. You beat the market by beating your human urges. I mean, that's kind of funny actually. There's like, the market is just the manifestation of the marginal investor. The marginal investor's time frame, their emotions, their mood, and yada yada, and they're very human. That's why it is the consensus emotion, etc. Mr. Market is typically never been more short-term focused. It's as always emotional. It tends to overreact and all that. So I mean, as long as we don't do all of that as well. I mean, if you function exactly like Mr. Market or even worse, obviously you're never gonna make money. So it's like, I just put up a list here. It's like, able to be bored, that's an edge, because who the hell likes to be bored? Able to wait, that's an edge, because who the hell wants to wait? Nobody today, increasingly so. Nobody wants to wait for anything. I saw a tweet by Michael Saylor where he was calming people. It's like, hey, don't sell Bitcoin, because it usually a downtrend usually turns around within 48 hours. I mean, Jesus, can it be more obvious? That's like, even the high priest knows that. And maybe he might be scared to death right now, given this, how this chart looks. You know what I mean? It's like, oh, don't sell. I mean, we can't break this down, because then all the traders will pile in, and then it's gonna have a margin call or something. But it just goes to show that he has to like remind people, like, please stick it out for 48 hours. I mean, Jesus Christ, is there a more like confirmation of just how short term most people are? Even though, again, Bitcoin is supposed to be the perpetual wealth machine, and it's going to go to $100 trillion and yada yada yada. No, he knows how. I mean, I bet he knows how most people look at Bitcoin, and I personally think that I don't believe everything he's saying, if you know what I mean. But anyway, I did this list. So if you just look at the list, again, these are edges. Able to look for solid returns. What I mean by this is, most people look for outrageous return in a short time frame. Everybody's looking about the next. Everyone's looking for the next rocket. What might go up? What might go up 100% within the next week or month? That's what everybody's busy looking at. Same with whatever, looking at charts. Oh, this is breaking out. I didn't buy it when it was 50% lower down, but now I'm going to buy just because I think that in the short term price is going to go higher. If you're just, and I'm going to get to that later, I think I did a tweet about that. It's like, seriously, I mean, how easy it is to find something that for sure is going to go up 100% within 1 month? That's a express way to the poorhouse to be looking for that, in my opinion. 100% over 2 years is an exceptional return. Do you think there are cases out there that if you had pretty diversified portfolio, even in juniors, do you think that the average case could have a probable 100% return from these dirt cheap levels over the next 2 years, I don't think you would have any problems finding a portfolio like that. Most don't look for it, so they don't find it anyway. And most, even if you gave them a portfolio like that, for example, it wouldn't be good enough, because who the hell wants to wait 2 years for a 100% return? Yeah, exactly. Nobody. So that's an edge as well, to have like realistic, solid returns within a acceptable time frame. 100% in 2 years is way too boring for most people. That's why they don't even care about stories that could deliver that, and that's why they're probably not even gonna deliver 100% over 2 years, but rather like 200-300% or something like that. Because if they were gonna yeah, I mean, it simply would be too cheap. So it's like, if there is a story, it's like, oh, this is worth 100 million. The company's saying, oh, we're probably gonna be worth 200 million in 2 years. That would get sold off. You're probably trading at 50 million today. So even if you're looking for just solid returns, I think you can have really good returns with pretty low risk as well. Again, assuming some diversification and margin of safety. Able to do work, due diligence, that's an edge. How many actually do that? How many actually look into companies? Not much, not many. People read some stuff somebody said about a company, and it's like, oh, 10 million ounces, 30 million ounces, or this is gonna for sure go up because of X, Y, or Z, and they just buy. They just buy the mood in the forum, for example. Don't do much in terms of work. I mean, one personal example. I mean, look at how much due diligence I did on First Nordic. I mean, it took me a month to just summarize and write down all the findings and everything I thought about First Nordic. So you can imagine how many hours I spent doing that, and how many hours have gone into like just thinking about First Nordic and finding stuff out and researching, etc. So it's like, yeah, if you do the work, that's an edge, and I mean, that this is earning all of this is earning good returns. Able to be bored, if you are able to do that, you earn better returns than most. Able to wait, earning returns. Able to consider many aspects at the same time, edge. Again, the market focuses on one thing only, and that's why the Lundins, I've said it a bunch of times, why spin-outs tend to work, because the market always kind of focuses on one thing and one thing only, and that's what it's priced for. So if you have a few, I mean, many juniors have like peripheral assets, and those assets are like, I mean, almost worth nothing anyway. And I mean, most juniors don't even have good flagship projects, so you can guess what the quality, let's say, or the value is of the peripheral assets that they're not even working. But some companies have legitimate peripheral values, like in First Nordic's case, Ojärvi. Nobody gives a shit about Ojärvi. I haven't talked about Ojärvi in the last week. Nobody talks about Ojärvi in the forum, but that is literally a very solid project. That's an Agnico work project. Yes, it's not a billions of dollars type project. I don't think so, at least. But it's wide open, highest grade AU equivalent deposit, I think, in Finland. Is that worth something? Absolutely. It's wide open. How much is it worth? I mean, I know some people who've looked at First Nordic say that, oh, they really want Ojärvi to get spun out because they think it could be at least $100 million story in the future. And of course, if they actually find like 1 to 2 million ounces of high grade gold, I mean, that could be a lot more than 100 million market cap for that spin out like that. But is anybody actually factoring that in? Are we paying for that in First Nordic today? No, we're not even paying for 45% of maybe a top 10 gold project in the world. If I care about that, if I buy stocks that reflect the fact that, oh, I think Ojärvi is going to get spun out one day, and that could at least be a 20 million market cap company to begin with. It's like it's at least worth, let's say, 20 million $20 million in value. I mean, at 100 million, that's 20%. I mean, First Nordic 100 million, that's 20% of what you bought the entire company for, that you kind of get in dividends back just from Ojärvi. That changes things a lot, because then you're kind of whatever paying 80% for the Swedish assets, and then it's just even less for Barsele, and even less for, nothing, of course, for the exploration potential. So huge implications if you can again have more than just Barsele, for example, in your head, assuming that the other aspects are actually significant in a sense. I mean, if the market doesn't force us to pay anything for Aida, Harpsund, and Ojärvi, and Storjuktan, and Klippen, etc. I mean, 1 million ounces at Aida could be like $400 million in a hub and spoke. I mean, 1.5 might be whatever, 6 to 800 million. It's like, these are not, I'm not saying they're gonna for sure find that, but when you appreciate facts like that could be there, and they're gonna test it this year. So should I really not consider the fact that, okay, they're fully funded and I'm not paying for it, and if Aida becomes a 1 million ounce deposit, that could be worth like hundreds of millions of dollars. Of course I want to consider that when I'm buying it, especially if I'm a longer term investor, and especially if I can buy, when I buy in, I get Barsele for free anyway. So at face value, I'm not even taking any upside risk at Aida, but I get all the potential benefits, all the reward without taking risk. Huge implications. Able to care about Enners 5+ months out. Yes, this is an edge. Let's face it. Nobody, I mean, look at any forum. It's like pretty much all the talk, 80% of the content will be about the next news release. I mean, people basically, depending on how hot the story is, like, especially since most people are not really investors, they just want the price to go higher so they can sell, or they want it to go higher so they feel better about it, and whatever. So it's like sometimes there's a frenzy. It's like everybody just hyping up the very next news release so the price will go up. So sometimes they might sell into that, of course. But that's the focus. Do some own research. Look at how people operate. Able to forever know that the cyclical sector is cyclical. That's actually an low, or might be hard to believe, but that's actually an edge. Most people do not remember that a cyclical sector is going to be forever cyclical. Like Pierre Lassonde says, the gold sector is the easiest sector in the world because it always crashes and always rallies. At every low, people forget that it will always rally. For some reason, even though it's never happened in the history of the mining space that a bear market has lasted forever, everybody assumes this time is different. So that's actually an edge. And that's why that helps a lot with just, conviction to buy this sector, because it's like, I know there's 100% guarantee of a bull coming. I don't know when. I think it has already started. I think it started last year, but it's like not an obvious raging bull yet. It might start this year, might start next year. Whenever it starts, whatever company is still around at that point in time will go up a lot. So the name of the game is staying power, and in the meantime finding the absolute best risk rewards you can possibly find. So you are already deployed, because when the bull gets obvious, most of the gains are already gone. Able to differentiate between price and value. That's an edge. And again, if this might sound corny or something, but seriously, how many do you actually think check even one of these boxes? There's plenty of people, some big whiners on Twitter, that I would say checks none of these boxes. They're not able to be bored. They can't wait for anything. They have obscene return expectations and timeframes. They're not prepared to do much in terms of work. they don't. I mean, most of their time and energy is spent whining about the sector, and they don't take any responsibility for their portfolios or their picks or their decisions. Just buy juniors because silver's gonna go to $100, whatever. Then they whine as long as they're not up 500%. Able to consider many aspects of it at the same time, very few, and that's even for myself because you need that. That's why I typically get more bullish when I write out a case, because then I force myself to actually look at all aspects of it. Because let's face it, even with current holdings, it's like you can't when you think about a case, you cannot have all aspects in your head at the same time. There is going to be some part of it that's going to be the take up the majority space, and that's how you're also going to, your emotional value estimation is going to be affected by your mental focus span, if that makes any sense. So that's why it's actually good to revisit cases. And seriously, I mean, sometimes I own a case or have owned a case, whatever, and then I go through what I wrote when I wrote it up. It's like go through the article, and that just again makes me more bullish. Or it's like, oh yeah, I mean, I actually forgot about stuff like that. So this is like something that needs to actually be refreshed, because again, there's no way you're going to be holding all the aspects. I mean, when I write in, a good example is like First Nordic Forums. Like, there's going to be one topic that's most of us will be talking about. It's like maybe the Swedish listing, but it's like, okay, then I kind of forget the fact that, oh man, we have a discovery at IDA already, or you know what I mean, because you can't speak about every topic in one sentence or in one conversation, but it can all fit in a 70-page article. Able to care about news releases 3 months out. This you see all the time. That's why also, I mean, when what was I gonna say? This you again see all the time. Again, going back to First Nordic, I think there's a ton of potential for. I mean, we haven't started diamond drilling yet. So it's like all of the drilling. I don't think that's really factored in yet. I think maybe the reason. I was gonna say, okay, what's making it go up right now? For example, I mean, I think it's mostly people just figuring out the case. I don't think, again, I don't think any exploration success at all is priced in for the 100% owned targets. Because when you think about it, let's say they spend $8 million drilling 20 to 30,000 meters and they don't come up with much. Okay, what are you gonna say? Let's say the market cap is what it is now. Let's say 100 million. It's like, well, Barsele is worth $1 billion. They own 45% of it right now, so that's 450 million. It's not going to be expensive, so it's all for free. And there's also a chance that after $8 million has been spent, and they could have made 1, 2, 3 discoveries, which could have huge implications for a 100 million market cap company with a 45% of a hub worth $1 billion already. So it's like we're not most of the stuff is not being priced in, and this is of course, again, fast forward, let's say 3 months, and it's announced that whatever IDA is being drilled or something, or they're gonna be drilling this, or 4 months out where it's like we're on hole 6 or something like that, and people are gonna be start talking. It's like, what if they what if they prove that IDA is the legit deal? Maybe it's a new Barsele. What do you think? I mean, what's the emotional value going to be put on First Nordic? Higher than 100 million? Yeah, I think so. Able Forever again. Well, I've gone through most of these, but seriously, I mean, think about it. How many do you actually think checks? I'm not. Let's pretend that, I think I did a tweet about that as well. Let's pretend that each edge here, I mean, they will all have different impact. But let's say if you are able to get bored, you're going to have 2% higher return. If you're able to wait, you're gonna have another. I mean, that's kind of. I mean, they uh, overlap, of course, but like, let's say 2% from this. Able to look for solid returns. I was gonna say more maybe rational returns, whatever. It's like plus 5%. Able to do work, plus 5%. Able to consider many aspects, plus 5%. Whatever. Yeah, etc. etc. So even if imagine if you use all these edges, all of that is going to add up over the long term in your long term portfolio returns. If you can't be bored, you're going to have a minus expected return. Your investment returns, if you had all the others but not this, minus 2%. Then able to wait, minus 2%. So it's punishing you. Your long term returns are going to be worse the more of these edges you're not using and instead get abused by. Basically, the more you are like Mr. Market or even worse. So obviously, if we want to have the highest possible risk-adjusted, let call it like that, returns, we want to stack and use as many edges as we can. We want to be the few to actually do the work and can figure out something, and also that gives us conviction. We want to be able in our investment decisions to consider many aspects that nobody gives a shit about now but can play a part in the future, and then we get returns. Able to care about news release, so we're buying stuff in the future for free today, and when that future is here we get paid, but then you obviously have to know the case, done the due diligence, figure out what the news releases be, and then also be able to wait and be bored until that 3+ month period is the present. Able to forever know that a cyclical sector is cyclical. Don't buy into the bullshit that this time is different and the minor juniors are never going to go higher, so you might as well sell now before they go even lower. Able to differentiate between price and value. If you think that the market is always right, what the hell are you doing stock picking to begin with? Yada yada yada. Makes perfect sense. And I reiterate and you can come up with much more potential edges. These are just off the top of my head. How many do you think people actually employ? I think most people don't do any of these, but they still look for outrageous returns and cannot for the life of them figure out why if they're into juniors and you're into juniors and you use all of these edges, why aren't your returns the same over a 4-year period? They can figure it out because in their mind it's like, well, I mean, basically that you just expect to be privileged enough that I shouldn't really be needing to do anything I don't like working or waiting or considering stuff or looking farther out or remember this fact or differentiate between this, but I'm still investing and I expect to have good returns. I mean, most people don't earn any returns at all. Yeah, okay, now it's getting long, so I'm gonna try to skip through a few of these. Yeah, counterintuitive that the more actions we take, the worse our returns are expected to be, yet the best investors are dead. That's proving the point. I've talked about this before, which is kind of funny. Fidelity did a study. It's like the best investors they had were the people that forgotten they had a portfolio and or people who had died and couldn't trade. Which basically suggests that and kind of proves the point. That's like if 95% of active investors underperform an index, if they can't be active, they're going to have better returns. So in a sense, that's suggesting that for most people, the more buy and sells we do, the worse our returns are going to be. Which is very counterintuitive because it's like, the less I go to the gym, the better my the more muscle mass and the more fit I'm gonna be. It's like, the less I spend time on learning Spanish, the better my Spanish is gonna be. It's pretty much the only human endeavor where activity is actually most of the time causing worse results. Um, yeah, and just pointing out, to know what will go up 100% in a month is beyond hard to know. I mean, I don't even look for that because that's like a siren song. Are there things that are gonna go up 100% in a month and can? Yes, of course. There's a lot of things, a lot of cases out there. Does anybody know which one? Absolutely not. How many of the ones that could go up 100% in a month will go up 100% in a month? I don't know. 1 in 100, 5 in 100, whatever. Impossible to know, really. So it's almost again a siren song to even care about it. To identify cases that on average are expected to do 100% over 2 years is very much attainable and will still give absurdly good compounding. Again, this, in my opinion, is a fact, and but it's simply too boring. Again, able to be bored, able to wait. Simply too boring. People want to get rich today. That's why, I mean, basically more people are invested in Dogecoin than are invested in real asset juniors, because in Dogecoin, everybody there is no value, but it can still go up 100% in a month if enough people think it will go up 100% in a month. And it's a trading sardine. So more people are interested in literal gambling, short-term gambling, than are interested in buying real assets at generational cheap levels, proving the point. Yeah, like I said, you and I know that most are not checking one of these boxes. Yeah, I think that's about it. I actually think these were some good concepts, and I don't know how many actually can suffer through my long rants, etc. But that's literally goes into able to do work. Um, I know a lot of people, but there's some people that whine about this sector to me, etc. And uh, even if I sent them like, here's a video where I talk about this, they're not gonna go through it. Most people, vast majority of people, are way too lazy. And I mean, if you look at the mining education tab I have on my site, there's a bunch of clips to, presentations by Brent Cook, Rick Rule, and other investors. I mean, I've pretty much watched all of them, some of them a few times over. So you can imagine that I've spent probably thousands of hours uh, going through, well, anything that's really mining investing related. Uh, that's doing the work. Uh, I should, if I use more of these edges, and especially willing to do the work, you have no right to have better returns than me. If somebody has the same degree of all of these as I, for example, but is able to wait even more, or is able to be even more bored than me, he might have even better risk adjusted returns than I should have. Or he does even more due diligence. Because one thing I tend not to do is call up management teams and keep digging and whatever. I don't know. That's not fun for me. And the same with actually financials and stuff. Like I'm not good with I'm not good with financials like cap structure, and I know people who like really research who gets into a private placements and who's really behind it, and figure out what their intentions are and stuff like that. To me, that's just too boring. Uh, and sometimes there's tools, or yeah, maybe one could call them tools, but it's like ways of going about things that somebody might have a very high emphasis on some aspects. It's like, well, the share count is too high, so that's above their threshold, so they're not interested. And in doing so, maybe they screen out a case where it's like, yeah, it doesn't really matter because, well, I'm not going to say really matter, but the other factors are so favorable that it doesn't really matter in the end. Um, and so let's say I have strengths in different areas, let's say risk reward or whatever, and sometimes I feel like, how to put this, there's like I can't maybe be as strict or too strict on some other aspects because they're gonna be cutting me down at the knees in terms of my strengths. There's like from my us, what I focus on that perspective, something might be a buy, but it's but that might come with some. How should I put it? Oh well, one thing for example, like okay, value investing. There are stories out there that have very tight share structure and good backers and all that, and have a higher valuation than I think they should have. So they're not that cheap relative in relative terms, but they obviously still check the share or tight share structure and the good backing, and they've done well, etc. Now one could say, well, you should identify them before they do well, and yes, that's also one thing. But it's like in order to find something really cheap from a value investor's perspective, it tends to come with maybe not the best share structure. Maybe it is a story that, I mean, in First Nordisk's case, where it's like it's actually been around. It was hot for a period of time, uh, became extremely boring, so it got priced like that because the market hates boredom, of course. So that creates the opportunity, but it's like, is the share structure perfect in a sense? No, there might be some um, disgruntled investors who just want to get out. I mean, we've been churning a lot of volumes in First Nordic, for example. Uh, so, I mean, the fact that it isn't a fresh story, the fact that there is a change in the case and a new company, yada, 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 and some might not like the new version of the company. They preferred Barcel Minerals alone, but not together with goal line, whatever, whatever. So that might create some turnover, etc. So in a sense, it's like some of the stuff I think correlates with what a value investor would see as cheap. And at the same time, if you flip it around, that some are extremely focused on backing, share structure, how tight the stock is, because like, hey, this has a much easier time to run. So even though they might not create as much value as a less tight stock, it can do as good or better. And that's also a strategy. It's just that it's not one that really fits my psyche, I think. I think I like uh, the more pure value investing point of view more so than looking at, oh, how is the deal structured. I mean, I know people who only look at deal structure, and you see, I mean, what's this? I mean, there's a Justra Junior in silver. What are they called? Uh, Argent? No. Some silver story at least that used to belong to, I think, Golden Minerals, and Golden Minerals had a bunch of assets, and including this one, and I think with Argentum silver maybe. So it's like a, in a sense, a known quantity in terms of the projects. Been around, didn't have much in terms of whatever. It's like it's not like it's changed, but it's in new hands on a standalone basis with the Justra machine backing it, and all that comes with that, like PR and I mean, whoever got into that, who has a network, and word gets around. I mean, they reached, I think, a market cap of like 70 million, which is probably on par or more than what Golden Minerals was trading for a lot of the time. So how do you explain that? It's like, well, a company that had that asset and a lot more had, I don't know exactly, but let's say a lower market cap than a company that only had that asset, and there's no change in the asset value really. Well, that can be explained by clean share structure, good PR, and all of that. So that's absolute. I mean, some focus on that more than anything else. How likely is it that this goes up? How easy is it for it to go up? I mean, look at Founders Metals. I think it's a pretty tight share structure, um, um, and has done very well. But I mean, if you just look at their results and compare it to peers, I don't know what the market cap is now, 470 million or 530 million or something, so $500 million already. Would you expect that story to have such a high market cap if you looked around the sector, then read the presentation of Founders Metals, where they have 50% of whatever their project is called? Would you assume? I mean, or let's put it like this, maybe a better example. First Nordic has 45% of a mine, a deposit that's already mine worthy, worked by Agnico. They have 45% of that, have 100 million market cap, 100 kilometers of strike in Sweden, with major targets to boot, and a project in Finland also having been worked by Agnico. If you saw that valuation, 100 million, without looking at the price, you threw up the presentation of Founders Metals, and you see there, they have some good drill results. They have this more discovery potential. They're in Suriname. They have 50% of the project right now, 50% interest, so they own half of what they've found. Would you guess they have a 5 times higher market cap? Would you have guessed that? There's no way I would have guessed. If First Nordic is selling for 100 million or so, I would think that Founders Metals might have a market cap of, I don't actually know, 80 million? I don't know, 150? I don't know. At least not a $500 million. So I think that comes down again to the tight share structure, good results, good PR. But that has had an easy time to move up because there are no disgruntled shareholders. It's a new story, a fresh story. Everybody who's in it is in the green already. So there's no again, there's not people. It's like, oh, when I get back to my break even, I'm gonna sell. So then you have to chew through people who just want to get out of the stock. So and that's again going back to the fact that those are reasons something can stay cheap for longer or become even cheaper than it should be, because there are human psychological factors like that, like legacy shareholders, yada yada. Founders has none of that, and has a tight share structure. So I think it has gone up way higher than it would be if it was a legacy story with the same exact news releases out. Which is, again, I mean, it just goes to show that investing is actually an art and not a science. So some people make money just looking at, or mostly looking at, who's behind it. Is it gonna have an easy time to go up, etc., etc. I'm more in the what's the actual value of this? What do they have? What am I paying for it? And don't consider or look too much into like, okay, who owns what stock? What's their intentions? It's just too boring for me. I mean, for better or for worse. Maybe I could implement it in some way. I just think that obviously there will be stories out there that, from my perspective, should be biased, but they might work because they fit how I go about things, but I wouldn't buy them because they don't fit some criteria that a lot of other people use to make actually good returns. So I think it's also comes down to how you how you're wired, kinda. I simply want to have fun while I invest as well. I That's why I don't really like trading because it's like you're just shuffling paper around. There's no depth to it. There's no meaning behind it. I don't actually feel like I own something. It's just that, oh, I'm gonna buy this and sell it later. It's like I don't care about money that much, so it's not that appetizing. Um, I have much more fun thinking about cases, figuring out stuff. I mean, the due diligence and the treasure hunt for me is the most fun part. Anyway, long rant as per usual. Congratulations if you made through all of this. I'm shocked if anybody were able to, but I would say I think these are exceptionally important things to consider. That there are no real free lunches. If we want to have good returns, 95% of people have returns, active investors' returns that are below a sector average. If we actually want to be the top 5% of people that actually can outperform an index, and preferably in over the long term, the more the better, we have to take responsibility, and we actually have to make sure that we are able to do stuff that few are willing and able to do, and thus increasingly so earn higher and higher returns the more edges we actually employ in our investment endeavors. Thanks for listening. Consider me biased if I talked about any companies. Assume I'm biased. Assume I own them. Some might be banner sponsors, etc. So I'm biased. Do your own due diligence. Don't invest in anything because I invest in it, or don't sell anything because I don't invest in it. I don't have a crystal ball. I buy what fits me, and I can't guarantee if what I own is going to go up or down. Yeah, don't invest money you cannot afford to lose. This is a high risk sector. You know the deal. Bye.